we have excellent panel, I think most experienced people, and Mr. Vijay Raval. He serves as Independent Director of India Focus Funds, and Kannan Srinivasan. He's a professor at Carnegie Mellon University's Tepper School of Business. And I think he would, I'm very keen on listening to him. I think please take a little more time. Sure, this is very educative. And Nishchal again, and Richie Sancheti, both are back from the pavilion, so they will intervene. But may I start with a small question to Vijay Bhai? Yes. Can you provide a quick overview of corporate governance in India, especially in the context of private equity investment? What you think?
Before I answer that question, Nishith Bhai, can I have your permission to say something which is supportive of what I do, you see?
Sure.
In many jurisdictions, it's not required that the private equity fund should have a board of directors. And in jurisdictions where private equities funds are required to have a board of directors, there is absolutely no consistency between the board governance. But I want to tell you, Nishith Bhai, and our people, you see, that times have changed. And what I see on the horizons, basically, whether it is investors are looking for more transparency and accountability. Our institutional investors are looking for more corporate governance. If you look at the regulatory bodies, including the SEC, which just issued 2 months ago a report of the compliance committee, you see, of their private equity examination, and they found 1 out of the 2 funds, you see, had some criminal violation of the Securities and Exchange Act. If you look at the court cases, basically, you see, they are all basically speaking up, that directors, you must perform your fiduciary duties. And most importantly, for the last few months or few years now, we have what we call activist investors. Formerly, some private equity companies used to go and be raiders in the other companies. Now, the investors in the private company have become extremely activist, basically, and they are looking at the management as well as the directors in terms of their performance, in terms of delay in exits, in terms of the fee structures, etc. And with all this background, Nishith Bhai, you see, I would urge basically that all private equity funds have a board of directors, and wherever they have a board of directors, they have some uniform, consistent governance standards. We need the fiduciary responsibilities at all levels, at the promoter level, at the investment advisor level, at the board level, at the trustees level, you see. I think with that thing, with that introductory comment of the importance of the subject, Nishith Bhai,
Yeah,
I would now like to move to corporate governance in India. Corporate governance in any country basically is very closely aligned to the country's development, economic development. In case of India, you can say from this measurement, it's a very nascent development. It started with the economic liberalization in 1990s, and slowly and gradually, it has been responding both to the economic development as well as, unfortunately, to some of the scams, most importantly, like the Satyam, you see. And the corporate governance in India is basically trying to find a balance between voluntary compliance, which is driven by the industries, and by the mandatory compliance, you see, which is driven by the gatekeepers like SEBI and the company's law, and by Institute of Chartered Accountants of India, Reserve Bank of India, and others. So it is progressing. It's progressing well, but it still has a long way ahead. Most of the Indian governance practices have been designed or modeled after the Anglo-Saxon corporate governance models, like Sarbanes-Oxley here or Cadbury Commission or others, but they have been modified because of the Indian situation. Like we have majority of the listed companies in India are still held by families, and they have to take that into consideration. And also, you see, in India, India's cultural ethos, you see, are very different from the Western countries. In Western countries, they had to take care of the agency gap situation, basically between the widely dispersed shareholders and the management. In India, yes, we have to take care of that, but we also have to take care of what we call dominant shareholders and minority shareholders. And shareholders and stakeholders like creditors, like employees, and including the social sector, including the environment. So it is slightly different. The success is mixed. In case of the listed companies, compliance with the corporate governance is higher. In case of non-listed companies, it's still not that high. In case of the companies which are basically governed by the private equity, it is believed that the corporate governance is much higher. The central focus, like in most of the countries for the corporate governance, is board of directors, and within the board of directors, the independent directors. And companies law is also basically getting stronger, as my friend will mention later. And we will also be talking a little later, Nishith, about the financial responsibilities and the court cases, you see. But when it comes to corporate governance in India, there are still few obstacles. Regulatory bodies, they don't talk to each other. The laws keep on changing. Sometimes it's complete uncertainty and flip-flops. Also in India, the judiciary system is extremely slow. If you need to go to a court for any reason, it can take up to 10 years before your case is settled. And there are two other things which are also hampering the progress of corporate governance in India. One is bribe, corruption, and fraud. The previous government, including the people who were placed in the highest places in the government, were not about the corruption. Hopefully, with the new government in place and the new laws in place, hopefully we can see some progress in case of the bribe and corruption. And bribe is happening mostly in case of the cash, and mostly because of the corporate and cultural reasons. You see, people are not coming out openly, basically, and using their whistleblowers' power. The last thing which also have some obstacle, you see, in terms of the corporate governance in India is we don't have enough independent, truly independent people of high integrity who are willing and able to serve as board of directors, you see. So these are some of the obstacles. So I can say basically that since liberalization, India's corporate governance has come a long way, but it's still a long, long way ahead. With respect to private equity and the corporate governance, private equity is extremely well positioned in terms of impacting the corporate governance for many reasons. The parent companies are mostly in Anglo-Saxon countries where there is established norms of corporate governance. Private equity company model itself basically requires, you see, that they look into the relationship between the general partner and also, you see, the limited partners. And private equity is itself basically very well positioned because it's known that the companies which are managed by the private companies are running extremely well, they're performing well, they can change the board of directors, and they can educate and develop the managers. Their yardsticks are very high. So I personally believe basically, that corporate governance and private equity have a lot to do, and private equity can make a tremendous contribution in India. But because of the obstacles which I have mentioned, you see, private equity has to be extremely careful when they first enter into India, because if they have a minority share in a portfolio company, that influence is limited. Similarly, they have to depend on the promoter most of the times to deliver the results, and therefore it behooves upon the foreign private equities basically that before they enter into the investment, they do their due diligence and do everything they have to do in terms of securing their contractual rights. So I would say both with respect to corporate governance and private equity, Nishith Bhai, as President Reagan used to say, trust but verify.
Yeah, thank you so much. I think I'll just give one light touch to your statement. You said litigations take about 10 years.
Yeah.
Sometimes it takes a little more and even more, because I think we're not in a hurry to resolve case. If we can't finish this life, we believe in reincarnation, so next life we can finish. So, we are cool that way. But I agree with you that I think we have to seriously do something about the litigation. Some things are underway. So high stakes litigations, there is a proposal that they pay extra fee to the court, and those cases will be out of turn. And arbitration has become a very important part of our, system, and that I think Vyapak will be talking about, but that's a point well taken. But Kannan, turning to you, what it takes to be a fund director and your real life experience, illustrating fund directors some kind of fiduciary expectations. So if you can just, I think you have been teaching corporate governance and other things, so it would be wonderful to have some words from you. Thank you.
Thank you. Let me kind of share my experiences both as being on the board of directors as an independent board member on funds and also on actual companies in India across different verticals. And then for a number of reasons where I chose not to be on directors, kind of providing some guidance and advice to promoters in the sense of being on an advisory board, kind of. So the way I think about India, if you kind of abstract away and think about it, what makes India both exciting and challenging is one statistical term. Much of my research is on big scale, large scale data, and so I always think in terms of numbers. So the term that comes to my mind is variance. India is variance in a number of dimensions. If you go to one part of India and go to another part of India, it's a fantastic, very different, challenging experience. You could drop into the latest airport, the new terminal in Mumbai, which is absolutely world class, better than any airport, certainly much better than JFK, which is not saying much. But you go to the other terminal in the same Mumbai, it's a terrible terminal, the old terminal, right? So you will see tremendous variation within very narrow areas. And so whenever you think about a vertical, in a number of verticals, you take something like real estate, you take something like retail, the quality variation in terms of companies or people is very high. And so that presents unique challenges to boards. That's not to say that's not variance in other countries. There certainly exists variance. But I don't know if it's a perfect analogy, but I would kind of like you to think about the scalable technology models in the Silicon Valley. There's a lot of variance, right? Tremendous number of companies come through, new ideas come through, some grow rapidly, some die quickly, right? So it's that type of, somewhat of an analog. So you've got a lot of variation. So you need to be very clear about that you have a lot of variation. Second word I want you to get into your mind is hybrid. What I mean by hybrid is there are a lot of borrowed business models, they've all been adapted to Indian conditions. So the first priority as a board member, the way I see it is, you should have an enthusiasm to learn about the business in which you're engaged in. You cannot simply go in for nice board meetings, and there are fabulous hotels in India, for those of you who haven't traveled, and you could sit in those board meetings, look through sheets of papers, make decisions and come out, and you don't have a good feel as to how the company operates. So my first principle is, if you're going to serve, and it's a fairly involved commitment, and I personally feel your fiduciary obligation should be to understand the business, and you get the visibility of it only if you are on the operational side of the equation. You as an independent board member, I personally feel you should understand the operations. You should see, that's when risk in any business is hard to quantify. And particularly it's hard to quantify for you, and these numbers don't tell you unless you have direct feel for that. So that's the first thing I would say that, and I think it's a mistake, and without naming companies, which is well managed and PE invested retail company in which I was quite surprised that as an independent board member, I had known a lot more about their operations and had actually gone and seen the operations much more than anybody from the nominee director from the investor side, right? So first you need to understand the operation sides of the equation so that you get various moving parts. There are a lot of moving parts. And in any company, the CFO, the legal counsel, and I would add CTO to that, perhaps in that order, are very important. And they are equally important or even more important in India. And this is the subtle things that you need to do. Mr. Pai mentioned, and I think that's the delicate thing that you need to do, the LPs want to know a lot. So as an independent board member, you want to be supportive, you don't want to be a roadblock, but you also need to do your fiduciary duty. Indian entrepreneurs, as you can imagine, everybody said things are so complex, things are so difficult. So what does it mean if you succeed in that complex, difficult environment? The DNA of an Indian entrepreneur is how to overcome obstacles that most other people will throw their hands and say, I cannot operate in this environment. So by definition, their DNA is to overcome obstacles. And if you are one of those who've got a lot of very accomplished individuals who sit on the board but aren't contributing, for the CEO, the board becomes one more obstacle to overcome. Just to persuade you to say, this is the right thing, just sign on to these things, approve what I say, right? Understanding the business, first of all, you earn the respect of the CEO. The CEOs in India truly start respecting only when you know you have, and I will tell you one independent director who probably doesn't want to be named, he said that I always get into the pants of every CEO. And if you do that, the CEOs really start respecting you because you understand their business, right? Otherwise, you're an obstacle to overcome. And in that process, it's a delicate process. You need to have a reasonably good assessment and judgments of the CFOs and the legal counsels. I think those are two key pivotal people I think of. Again, when you go to talent in India, there's a tremendous amount of talent, but with very high variance. Right? I hate to praise Nishith, but Nishith is class act. You can see. You can go to attorneys. I've been on companies with attorneys who cannot really answer any simple question. That makes you very uncomfortable. Right? So there's high degree of variance. First of all, you want to make sure, and particularly in a very rapidly growing organization, a CFO who could handle a $200 million business, a $20 million business, cannot handle a $1 billion business, and the complexity of the structures. But India is also about relationships. CEOs have been in the hard times, they've stayed with them, so they have a hard time letting some of them go and getting good quality people into the process. Second thing with CFOs is, I tend to develop a reasonably good relationship. Sometimes there are a lot of smart people who will tell you things that they are reluctant to tell the CEO. Because CEOs have dominant personalities. We talked about growth. India's growing market, everybody scales. There was some discussion about debt. What are the big challenges in India? Inflation rates are very high. Therefore, interest rates are very high. Everybody tries to hoard cash wherever they can. Your suppliers will try to take the longest time to pay. right? So cash is a very big issue. So when you rapidly scale, you really want to understand the risks, do a good free cash flow analysis, push the CFOs if they do the risk analysis. Because if there is illiquidity, the instruments that are available in a mature market like US are simply not available to you. Things freeze up very, very, very quickly, right? So get the CFOs to do the sensitivity analysis. And sometimes they've done it, they cannot present it to the CEO. They are a little reluctant. CEOs can go about the expansion. And as a board, these are some of the interesting things that you need to do. And in a legal case, I'll give you a very specific example. In a legal case, Mumbai, those of you who know Mumbai, this is actually, I really like the CEO. This is a very entrepreneurial CEO, but seriously thinking about how to make it into the next generation company. So he's interested in putting the processes in place, improve, reach out to world standards, and so on and so forth. So Mumbai, as you know, is one of the most expensive real estate markets in the world, and has the only over $1 billion individual house in the world. And so Mumbai, the problem everybody talked about, so I won't repeat it too much, the approval processes are horrendous. So when a promoter is a founder, when a founder goes and buys a nice piece of land, says, I'm going to build apartments, so a lot of demand, but nobody has visibility on how long it would take. There is some asymmetry in the information. The founder knows a lot more about the nitty-gritties of that. He's not going to reveal all of that because, again, I told you cost of capital in real estate is about 24 or 25%. For those of you who are used to numbers, its cost of capital is 24%. If something gets delayed by 3 years, your costs have simply doubled, okay, because of compounding. So in this particular instance, what had happened was, so Mumbai, so a lot of developers initiated nice areas, so there would be a lot of flow of money. They will take significant advances, 50%, 60%, and simply say, I haven't gotten approval. And there is no, well, they don't know, I have applied. So we don't know whether they are expediting, and then the people who paid get very upset and say they've complained, and so this has become a big issue. So Mumbai bought a rule, and mind you, one of the things that I'm sure Nishith can answer this better than I can, things can quickly go criminal in India. They are not civil. So one of the things that they said was, it's a criminal penalty. So Mumbai said, I'm going to clean it up. Unless you have the approvals, you cannot sell anything. Okay. So here is a story. And this is a national real estate company, so different parts have different rules and regulations. An international investor comes and invests, a local, very well-known company, very well-established company, makes about, over $100 million investment into this project. And what they have done is, as a way of investing into the project, they've taken options to buy 12 apartments in the same building, because such a prime area, they said that. So here is a delicate issue, it's a gray area. We as a board didn't know initially. We didn't know the rule that Mumbai had this rule, so we all approved it in principle. When the accounting firm pulled up and said that these options to buy can be viewed as a pre-sale. So it does not go through the rule. So they refused, the auditor said that this is not legally compliant. So then we all said, well, the auditor fortunately stood the ground, and then we made the company go through independent legal. So the CEO was saying, no, I don't think that's the case. The legal counsel was wobbly, didn't say much. And then we suggested that you go to an independent legal opinion. The legal opinion was, yes, this probably should not be done. So we had to redo the whole investment. I'm telling you a little bit of an example. And so after that discussion, I was very comfortable as a board member insisting that we do an independent due diligence in the legal sense. And then I called up the other independent board member. I said, what was the legal counsel doing? Why didn't the legal counsel within the company alert us to this issue? Why didn't they alert us to the board? And then over a period of time persuaded the CEO that you need to get stronger legal counsel, because the issues with respect to real estate are very complicated. And so you need to get much better legal counsel. So it tells you the level of involvement and engagement that you need to be in the process of this. And the side story of this is, so I personally think if you're not curious about learning, if you find, so what does it mean for a lot of PE people? If you're a GP and you're investing into companies, I would certainly say just don't give them money. Look at the background of these board members. Engage them, talk to them, do some due diligence on who the board members are, particularly the independent board members. A related question, in India, the compensation is pretty low. It's not very high, right? It's an old story, right? If you pay peanuts, what do you get? Right? And so they are not geared up to paying compensation. So in that, so unless somebody is truly interested, you will get a lot of rubber-stamped independent board members, which when things are going well is fine, but when things blow up, substantially increase the liability of the company. And the short term, the new Companies Act have come in and there is greater burden, and I'm not going to go into this. I almost never sit on audit committee, even though I personally have learned so much about tax and audit, but when I have someone like Vijay Raval, who has got a lot more experience in that, I don't serve on audit committees because these are very complex things and you need to really know well, right? So you pick and choose. Another suggestion I have for you is that now a lot of people, it's very hard for me to be persuaded to be on board members. As a board member on companies, I decline more requests than what I accept. One additional interesting way might be to strengthen this process. You're not going to easily change this. One interesting way is to put strong advisory committees. Their liabilities, so all of us are a little bit worried about the liability, but there can be a lot of smart people who understand these things and are willing to spend time. So make sure they're willing to spend time, understand what goes on, and willing to invest. And these are some of the broad comments I have about this.
That was absolutely marvelous because you captured all the experiences in real life. You got it, you know, and good stories actually, but good learning lessons. And all of us have seen so many incidences lately that now it has become very tricky to become director actually, and very few good directors are available. So I think they can add tremendous amount of value, but as you rightly said, people are not willing to compensate even directors, and that again makes it a little more complicated, the whole situation. But let's see how things go. And government is suggesting that they are going to review the New Companies Act. In fact, they already made a positive statement on that, because I think they have found there are a lot of glitches in it. The whole exercise started well with the J.J. Irani, Tata director, working on the whole thing, but when they actually came out of the piece, it got messed up. Of course, some provisions are good, but many of the provisions have some difficulties. Okay. So, but let me ask Richie, maybe, what's the emerging jurisprudence on fund governance based on recent court decisions? What I would like to do is, we are again running short of time, but if we can take a couple of minutes and then we can open up to question and answers, and maybe Nishchal will be able to say something. And
so I think there's a distinction between corporate governance in a context of a portfolio company and governance standards fiduciaries owed in a fund sort of a structure. So while Professor Kannan focused more on corporate governance aspects on portfolio, I'll be focusing more on a fund platform. Here the counterparties you're talking about, or the characters you're talking about, is essentially your LPs, who are your investors, your fund manager, and the fund vehicle itself. So between these three, let's just first try to understand what is a fund to begin with. Funds are pretty much privately held limited partnership structures. Now, there are functional variations to this in different jurisdictions. Like when we say limited partnership, what it essentially means is that the fund investor is contributing capital to the structure. They do not technically, and in a typical case, inherit any voting rights. All their powers, etc., are derived from the contractual arrangements that they have, pretty much the LP agreement that they have negotiated with the GP. Here, a lot of power goes to the fund manager. And even though there could be structural alternatives, like let's say a company, but even if the fund is set up as a company, the board is appointed by the manager. The investors, again, are holding non-voting shares, so to speak. If in an Indian context you use trust structures, again, it is the fund manager who's appointing the trustee, etc., and the contributors are only providing capital. So pretty much the common thesis is, unlike a typical corporate structure, in a fund, the investor does not hold voting rights per se, and so they do not technically access the rights which a typical shareholder would have otherwise held. So that is the base in which funds stand apart from a typical corporate structure. Now again, try to understand the distinction between a private equity fund and a hedge fund, because then that is how the fiduciary aspects come into play. Now a private equity fund are long-term, illiquid structures. You are locked in for a defined term, 5 years, 7 years term, 10 years. And of course, these are illiquid investments. You can't sort of claim a redemption or an exit, when there's a defined tenure for the fund. As opposed to that, a hedge fund has a slightly more liquid asset class. The investor here has the right to sort of seek a redemption. So the manager is on his feet at most of the times to make sure that, okay, the investments are right, the investors are getting a return. Otherwise, the investor has the right to pull the plug. So is a hedge fund very different from a private equity fund? Answer could be no, because even in private equity funds, you have the sword of, without cause removals for the fund manager. So what is essentially a fiduciary? So fiduciary was sort of, and just to refer to a case in Page Capital Fund, etc., they sort of answered this by saying that if by virtue of the terms of your appointment, if a lot of powers are vested into you, you owe a fiduciary responsibility. Fiduciary essentially means the requirement to act in a reasonable manner. Now, what is reasonable depends on case to case, number one. And also in a fund context, what is most interesting is if I, as a fund manager, owe fiduciary responsibilities, to whom do I owe this fiduciary? Is it to the fund which I'm managing, or is it to the investors to the fund? Because there could be contexts and scenarios where what is good for the fund may not be good for the LPs. So in the context of, let's say, the same case, Page Capital, what had happened is, in a hedge fund scenario, the manager had, sort of put a gate just to stop an LP, from exiting or redeeming his position. Now, the reason they used is that, okay, the fund would lose capital, etc., which may not make the investment thesis viable anymore. So what he did was justify this as a fiduciary owed to the fund. But what the Grand Court in Cayman Islands held was that, okay, because you're managing structures where the investor has no other right but is relying on contracts, and you have a duty to act reasonable, you owe the LPs directly a fiduciary responsibility. Now, again, given that participation is largely by private equity funds, another example is in case of Weavering, where there was a lot of learning out of it. What had happened is 2 of the fund directors were related to the fund manager and were sort of rubber stamping whatever decisions or positions that the fund manager was taking. Here, what had happened is that the value of the assets shrunk drastically. So here the Cayman court again found out that, okay, the directors were found to be doing nothing, and they went on doing nothing. You were only rubber stamping what the fund manager was telling you without objectively applying yourself. So, it was found against the directors, and they were penalized for $111 million. And the rationale used to arrive at this figure of penalty was very interesting. What they said was that hypothetically, had you as directors performed your duties and obligations, in other words, you had performed the fiduciary you owed, the fund would have been at position X. But the actual position is Y. So X minus Y is the difference. And all this is owing to because you didn't perform your fiduciary properly. So that is, the extent on which, fiduciaries can come into play in a fund sort of a structure. So there are a lot of interesting learnings, and I think I'll wrap it up here. Learnings are that, okay, like Professor Kannan said, there has to be a lot of activity for fund directors. It should be between board meetings as opposed to during board meetings. So it's not just attending those fund board minutes, etc. The minutes are capturing whatever you discussed, but you have to demonstrate that between the meetings you performed, you engage with the auditors, you engage with the administrators, you looked at the fund documents that, okay, if the manager has been indicated that these are the limits within which the fund has to invest. Let's say, again, in a hedge fund context, like you cannot take exposure beyond 60% in a particular asset without taking IC approval, etc. Have you actually breached those limits? Those are the elements where, the fiduciaries can come into play. I think I'll,
Yeah, maybe I think, Nishchal, what are your thoughts on the duties, liabilities of the director serving on Indian funds or Indian portfolio company? Very quickly, if you can get a glimpse.
So I echo what Professor Kannan said, that independent directors are in a very tricky situation. When things go wrong, they are the first to be blamed. When things go right, it's because of the founders. So they don't get the credit, and when things are not going well, they are the first people to be blamed by media as to what were they doing when these things were happening. So it's a tough job to become an independent director on the board of Indian company, especially because of the fact that the Indian companies have traditionally been promoter or founder driven, where majority of the shareholding, even in listed companies in India, is of the founders or the promoters. And hence, because they have majority of shareholding, they also have majority representation on the board. So in a board which is largely dominated by the founders or the promoters, at times the independent directors don't want to rock the boat by displeasing the promoter or the nominees of the promoter on the board of the company. So, but at the same time, there have been, I at least had good experience with one of the private companies, and it's quite interesting. And I think that was the first time when I realized the corporate governance being actually practiced in India. This was a private company where under the Indian laws there is no need to have any independent director. Still the promoter went on and had almost 1/3 of the board as independent director. We were actually doing one transaction for that company where the one private equity fund was being bought out by another private equity fund, and the structure was a bit complex because of the difference in the valuation with the seller wanted and the buyer wanted. So the promoter stepped in and decided to compensate the buyer for the difference in the, compensate the seller and the buyer for the difference in the valuation for the same stake. So it was quite a complicated structure. We devised the entire structure. Promoter cleared the structure. And interestingly, we are going to sign the deal in a week's time. But the promoter said that you have to convince my independent directors. So I personally flew down to Kolkata and Delhi, where 2 independent directors were residing, and they actually grilled me for at least a couple of hours on the structure. And even after grilling, they said that we want this one small change in the structure, without which we are not going to approve this in the board meeting. And the promoter said, we will go with whatever changes the independent directors have suggested, and then only do the deal, irrespective of the fact whether the deal gets delayed by 15 days, 20 days, I don't care. But as a measure of corporate governance, even though we are a private company, we want to ensure that our governance is much better than the listed companies in India. So that was an excellent example of corporate governance being actually practiced in India. Now, interestingly, on the flip side, there was a survey which was conducted by CNBC in India on the independent directors. And they found that many of the industry stalwarts have been independent directors on the board of 18 to 20 companies in India. And they actually came out with the data that they didn't attend more than 15 to 20% of the meetings which were conducted in the last 3 to 4 years. So out of 18 to 20 meetings, they attended only 3 or 4 meetings. Now that shows that the bandwidth issues which even the independent directors are facing, because on one hand you may be good, but if you're not able to devote time, then your expertise is of no use to the board of the company. So that's also something very interesting, which even the New Companies Act has mentioned, that the independent directors cannot be on the board of more than certain number of companies, because they actually face these issues, and the company boards didn't get any benefit from the independent directors. Another important aspect is the nominee directors of the fund, which is again quite interesting, given the fact that under the New Companies Act, there have been extensive duties of directors which have been laid down. And one of the conflict of interest which a nominee director of a fund always faces is, should he protect the interest of the shareholder who nominated him as a director, or should he protect the interest of all the shareholders of the company because he is on the board of the company? And clearly, it becomes a big challenge because under the Indian Companies Act and the corporate jurisprudence which has developed in India, the director has to first protect the interest of the company and all its shareholders, rather than specifically the shareholder who nominated the director on the board of the company. So issues arise in some of the cases we have seen in the investment agreements which have been negotiated. In the notice clause, the name of the nominee director is mentioned, and then the name of the fund. Now, it becomes quite challenging because the same director is also on the board of the company and he's also a nominee of the shareholder. So is he representing the company when a notice goes to him, or is he representing the shareholder? And all these conflicts arise when actually a dispute situation arises, and a lot of issues crop up because of this. Now, this last point I wanted to cover was what has started happening in India, and this is something which is very good for corporate governance, is we have started seeing a lot of shareholder activism in India, which was something which never used to happen in India. But since the last couple of years, we have started seeing the decisions of the board being questioned by some of the institutional shareholders. Now, traditionally in India, the institutional shareholders have always favored the founders, or what you call promoters in India. But slowly we are seeing a shift from favoring the founders or the promoters to actually favoring corporate governance. So the last case, the latest one being Tata Group, which is the most respected group in India. One of the group companies proposed compensation for hike in compensation for a couple of directors, in spite of the fact that the company had underperformed during that year. The shareholders, the shareholders rejected that proposal in the meeting, and that was something that was quite interesting because this thing had never happened earlier in India, where the institutional shareholders started attending the meetings, started looking at whether the directors actually deserve to be compensated so much in spite of the fact that the company has not been doing well. So that's it's a welcome change in India, and we hope that with this change we'll see a new standards of corporate governance being set in India.
Yeah. Vijay, would you like to just spend a minute or so on some final thoughts on Indian corporate governance and the empowered board?
Yeah, everything you heard, Nishith, you see, leads to one thing. You see, you can't be director in name anymore. You have to be engaged. You have to find the time. You have to understand the industry, because the real power is not going to come out of regulators. Real power is going to come out of your own expertise. And the time has come, Nishith, you see, for corporate governance, where the directors were ceremonial, with all the regulation and with all the things which are happening, they have now become managed directors, from ceremonial directors to managed director. And time has come now basically where the companies have to be basically directors-led corporations. It does not mean you have to basically do the day-to-day operations, and you have to clearly know where you can lead. For example, in terms of the strategy, in terms of the CEO appointment, etc., where you should collaborate with the CEO, like resources, like acquisition, like risk management, and where you should stay out. If you have that model in place, then you have moved from ceremonial to manage, and manage to corporate-led directorship.
Thank you so much, Vijay. I think we have 5 minutes for comments or questions, so would love to have something. I think any? Yeah. Please tell your name and.
Hi, my name is Ravi Surya. I manage a hedge fund in New York called Valmiki Capital.
Mm-hmm.
My question was for the professor and maybe the rest of the panel. As we look upon, we are looking at making a bunch of private investments in India over the next, say, decade. Where would you suggest we go to recruit independent directors? Is it academia, the legal profession, old IAS people, or do we just have to drag them, from the city and from Wall Street?
That's a good question. I don't know if there is an easy answer, but I think there is an informal social network. I think you need to use the informal social network, and like I said, I think, and Vijay Bhai and I, we don't have the time. we have been on a fund director, and the way we looked at, in fact, I think once we've overruled the legal advice, which said you're just to trust whatever that happens in the invested companies is really not your problem, and we kind of said, no, that's not the way we operate, right? So the real difficulty is not about whom you go after, not the legal or management experts or previous serial entrepreneurs. Who is willing to commit to the process? Because I think at the risk of oversimplifying, lots of times when independent directors get nominated, you look at their biodata or a resume, which is very impressive, and you say they've got all the right expertise, but do they have the desire to invest time, spend time, and do it? And that I think you're going to know only by socializing within your network and saying who kind of takes this job pretty seriously.
If I may add, a director should have a character to stand up to the management.
Yes.
Where he has honest disagreement, he has to speak up. He may have all the industry knowledge, he may have all the professional knowledge, you see, but if he does not have this inner character, he has to be driven constantly by his own integrity. And if he believes basically that he cannot stand up to the pressure, from the CFOs or CEO, he better not serve as an independent director. Because the entire corporate governance, if you look at it, basically revolves around one and only one thing, basically. Board of directors, and within the board of directors, independent directors, they have to be truly independent.
I totally sympathize and understand that philosophy. I sit on a bunch of boards here, and very often boards, even in this country, have conflict of interest.
I agree.
I was trying to see if I can get an answer for a practical solution, if you may. I totally understand and agree with the philosophical aspects of everything you mentioned. I just beyond the informal networks, which to me are by definition rife with conflicts, especially when in places like India, it just gets worse. I mean, yes, I grew up in India, so I have a vast social network. Not many of them I would actually put on a board of directorship. So it is, my question was, having the expertise that you have, if there was, is there a recruiting network? Are there professional recruiters? I'm actually trying to solve a problem that we are faced.
If I may just interrupt, I think CII and others have begun to collate some, list of directors. But the thing is that, you really have to, it just list, but then you have to really go deep into that and figure out who are
In the United
available.
States, Nishith, there are professional bodies. you see,
And
who
there are search agencies
whose only
now,
job is
Spencer
to find the
Stuart and
directors.
other ones have begun to do that.
Yeah,
But you also have to do your own homework. I think we have lots of comments I'm going to
Just one
give
point to
little
add. In fact, the Ministry of Corporate Affairs, under the new Companies Act of 2013, they are specifically creating a data bank of all the independent directors. So that's something which you can access. Obviously, all the background checks and everything will need to be done. But at least you will have a full data bank of all the independent directors in India.
Yeah, I think I have Chris here, Sridhar, and I think.
I was just going to second what you just said. And besides that, there are some of the global search firms who are very active in, kind of creating a database of potential directors. So, you could call Heidrick and Struggles or, Spencer Stewart. Any of them can help you out.
Yeah. Your name you did not say.
Oh, sorry, Bala Venkatesh, First
Yes.
Princeton Advisors.
Oh, thank you so much.
Thank you.
Chris?
Okay.
Yeah.
I don't think you're going to get good corporate governance in India until promoters view value in it, meaning that it actually has an impact on the valuation of companies. Until you have that, I don't think you're going to get it. It's very difficult to push it down the throat of a promoter for the reasons that Kannan you say. The other observation I'll make is that, which picks up on your point about management, is our experience is that the CFOs generally are quite weak, and they're quite weak in the sense that they view themselves as working for the promoter,
Yes.
not for the board,
Yes.
and they manage information, and they manage information to please the promoter.
Yes.
It's a very dangerous situation for
It is.
independent directors,
It is.
frankly.
Yeah.
Third,
ahead.
as a lawyer in the United States, I advise Americans not to go on boards of Indian companies. I hate to say that because it's because of the liability associated with it and the fact that civil matters get turned into criminal very quickly in India.
That's true.
Until that's fixed, I'm going to hesitate to advise Americans. to
Exactly,
go on.
and that's why we.
In fact, lot of private equity funds, especially the real estate funds investing into India, they have started just having a right to appoint director on the board of the company rather than actually having a director, coupled with an observer position in the company. So you get to know what's happening in the meetings through an observer position. And you also have a list of affirmative rights which are linked at the shareholder level. So in case of any decision which is taken at the board or shareholders level, unless funds consent is taken, those decisions cannot be taken. So that's another thing which is also happening in India. A couple of our fund clients have actually got their nominee directors, resigned from their portfolio companies, and they just now have a right to appoint director with an observer seat.
Yeah, I think in the next session we'll discuss some of the issues, but one point to note is that Minister Sitharaman, she made a statement that we are going to deal with this thing very strictly because people are converting breach of civil contract into a criminal thing. And that become a huge problem. So she has already taken cognizance of that and press came up. And in fact, Vyapak will deal with the recent case which Supreme Court has really discussed only last week or something like that. So he'll explain to you how Supreme Court has looked at this bailable and non-bailable offenses and, how do you put in. It would be very interesting to hear, so don't leave this place, okay? Otherwise, perhaps you'll find yourself in a wrong place. Okay. But I think, Sridhar, you have a last word always.
I have because I'm one of the affected persons. I wish you will moderate a panel with the same members when Arun Jaitley is here. In Institutional Investor Conference, September, I believe Mr. Jaitley has accepted.
Right.
And if Nishith could moderate a session with the same panels on directors, it will be very advantageous for the investment community. That's a statement, that was a question.
Sure. Tell me anytime I come every month. And now it's very easy to come from India. Sit at night, morning, you're
Having
here.
been an independent director in two of the large publicly listed companies in India and got gently eased out by the promoters for not voting with him on certain resolutions which would not have been interest of the minority shareholders. I want to ask the question now, how many Vijay Ravals are in India? Because I served on the board of a large public limited company where there were 4 independent directors. I can tell you other than myself, the other 3 were not independent directors and they've been on the board for many, many years. And one of them was even the former retired chairman and CEO of Securities and Board Exchange of India. So the problem is systemic
Correct.
in the family-owned companies. So there has to be a change in that perception.
True. Thank you so much for that comment. I think I don't have time to again ask people online if there are any, but I thank you so much and let's give a big round of applause.
Thank you.